Hey, everybody, welcome back. We're doing a special Thanksgiving podcast here today. So, on this episode of What's the Deal, the real estate podcast that gives answers, we'll be covering what's the deal with property insurance. Real estate is one of the few investment vehicles that you can purchase property insurance for, yay for hard assets. So, joining me today to provide some coverage on the topic of property insurance is my good friend and colleague, Greg Jones. So how we doing, Greg?
Good. How about you, Fernando?
I'm doing good. It's 72, 73 degrees outside in California. I'm glad I'm not in Chicago at the moment.
It's not quite that nice here right now.
Okay, so Greg, on this podcast, we have all types of listeners, from super professional, multi-million-dollar portfolio, all the way to the new investor or someone that is trying to become a new investor. So let's back up a little bit and explain who you are and what you do.
Got it. So my name is Greg Jones. I am a risk advisor with Crum-Halsted agency. So I work with real estate companies and developers, as well as contractors, around consulting around risk and placement of insurance.
How'd you get into the business?
I was introduced to a guy that owned an agency. This is probably almost 10 years ago now. Right place, right time. I grew up in a background of construction. Both my dad and my brother owned construction companies. Had friends that were in real estate, didn't want to do construction for a living. So I figured I would give insurance a try, and it ended up being a really good fit.
Oh, okay. I didn't know that about you.
Yeah.
Figured it would come up in one of those late night poker games.
Yeah, exactly.
Okay. So for people that don't know, what is property insurance and what does a risk advisor do?
So property insurance is realistically, it's a contract. So the owner of the property has a contract in place with an insurance company, say whether that's a Travelers or a Hartford or whoever the carrier might be. And in that contract, it will lay out, in the event of a claim, here's what the insurance company is going to pay out. And that covers both damage to the property, as well as if there's an injury to someone at the property. So the contract states what the limits are, what the causes of that claim are covered versus certain kinds of causes of claim might not be covered unless you buy that or purchase it as an add-on. A good example of that is earthquake coverage. Earthquake isn't automatically included, but you can purchase it as an additional coverage line item. But it's all built into a contract that lasts for 12 months between the owner and the insurance company.
Okay. And then with those types of let's bring it into reality with some examples. So say I'm a new investor. I'm going to be buying a 4-flat property in Chicago. I'm going to live in one unit myself, rent out the other 3 units. Let's say each unit's 1,200 square feet and the building's 100 years old.
Right.
What am I looking at for coverage, or what should I be looking at for coverage? Where are the premiums going to fall, and what are some things that I should be paying attention to or looking for in those contracts?
Right. So the first question you have to answer, especially because you're living in one of those units, is how are you going to cover the property? You could cover it on a personal insurance policy, or you could cover it on a commercial policy. Because it's 4 units, that's the breaking point. You could cover it either way. After you get to 5 units, it's always considered a commercial policy. Okay. If you go the route of commercial, which is typically what I recommend, the coverage form is a little bit broader in what it will cover you for. The downside is you have to treat yourself, because you're living in one of those units, as a tenant. You're a tenant within your own building. So your personal property as the resident isn't going to be covered, but your asset, the building, contents within the rental properties, those are covered under the contract. When you're looking at a 4-unit building, based on the square footage, there's typically a dollar amount that insurance carriers will look at in terms of, we want to cover this for what it will cost to replace it if you have a catastrophic loss, right? Yeah. every carrier has their own algorithms they'll use for this, but typically it comes down to a dollar amount per square foot. The average we're seeing, at least in Chicago right now, if it's joisted masonry or better, is typically anywhere from $150 to $170 a square foot is what it would cost to completely rebuild. So we would look at what does that cost look like. Then you can set up whatever deductible structure you want. Deductibles go as low as, I mean, realistically, you can go as low as usually $500. I never see anybody go that low. Usually the average is, 25 to, 10,000 for a deductible. So then if you do have a loss, everything that it's covered under that contract is paid out minus the cost of your deductible.
Now, one of the things that occurs quite often in Chicago is we have these pockets, these neighborhoods where the cost to buy the property is significantly below the replacement value. For example, my partner, Steven,
yeah,
he has a property where, it's a 140-year-old masonry and limestone building. The cost to replace that type of building would be 1.3, 1.4 million, but he bought it for significantly lower than that. In those types of situations, what do you recommend doing with the coverage amount, with the policy?
So it really comes down to, as the building owner, what is your goal in the event of a claim, right? So you want to make sure you have enough coverage so that if there's a partial claim, or a partial loss is what they call it. So let's say hail comes through and destroys the roof. It's not a total loss. You want to have enough to repair that roof.
Right.
The question is, if you were to have a catastrophic loss, the building is completely destroyed or it's damaged so much that the city comes in and says, you have to take this building down. It's now a safety hazard, right? In that kind of scenario, what do you want to do? Do you want to rebuild something there? Or would you rather just take the money and go buy something else and sell the land after the debris's been removed, right? Mm-hmm. So the answer to that question really drives how we advise. Typically in these situations, I find the investor really would rather just take the money and go buy something else, because that coverage amount that you've got for that partial loss is more than enough to buy at least another building like it in that area, or maybe even more, right? Mm-hmm. So you get this dilemma of, I bought it for, say 250,000, but it'll cost me 1.5 million to rebuild it, right? Mm-hmm. Insurance companies will allow you in some cases, and it depends on the carrier, but they will allow you to do what's called a stated amount, or some carriers call it a loss limit. So you as the building owner can say, this is how much I want to cover my building for. I recognize it's not enough to rebuild it, but I want to cover it. So let's use this building as an example. You buy it for 250K. Let's say it's 1.5 to fully rebuild it. And you say, I only want to cover it for $500,000. $500,000 will cover any partial loss that happens. If it's a total loss, I'd rather just take the money and go buy something else. Mm-hmm. The rating for that is typically a little bit higher, but it still ends up coming out much less than it would be if you were to fully insure it for $1.5 million.
And when you say rating, what do you mean by that?
So the premium for insurance for property is driven by a rate. So whatever value is selected for that building. So let's say $1 million for round number purposes. Mm-hmm. So you take that $1 million, divide it by 100, and you multiply it by a rate. And that equals your premium. So let's say it's you're getting a 20-cent rate. So for $1 million building, divide it by 10, multiply it by 0.20, that's your property premium.
I see.
Rates vary based on the asset type. So typically you'll see multifamily tends to be the highest rated asset class out there, where retail is considered a little bit less hazardous. Office and industrial tend to be considered the least risky. So you could have a building of the same square footage. Let's say you're at a 18-cent rate for an apartment building. Same size building would be a 10 to 12 cent rate for retail. You might get as low as 8 to 10 cents on office or industrial, just depending on what the asset class is and where it's located.
Interesting. Now, let's say someone, in what situations would somebody opt for the full replacement cost? Is that if you have like a super custom property that, you can't find anywhere else, or?
If you have a super custom property, or if the idea is I like where I'm located, the land has significant value, even if I was going to take the money, I would rebuild something here. I might not rebuild the same thing. So another way that you can do it is some carriers offer what's called functional replacement cost, right? I've seen this particularly with real estate related to older church properties. So, I mean, especially you think about Chicagoland, there's all of these churches that were built in the 1800s. The architecture's crazy. You're not going to rebuild one of those just like it stands right now, right? But you look at, if we were to have a total loss, we would want to rebuild something, same purpose, but we're not going to rebuild it the same way. And so you can use what's called a functional replacement cost, where you'll estimate based on, if we had a loss, what would we rebuild? What would the square footage be? Same questions, but you're not basing it on what's there. You're basing it on what you would build.
Right. That's interesting. With the property insurance business, there's a lot of moving parts, and it's one of those vendors in the real estate space that usually a lot of the investors don't actually know what goes on right behind the curtains here.
Right.
So walk us through, when I talk to you, it almost seems like every person that works within your organization is almost running like it's their own little business inside of the organization, almost like you're an entrepreneur or intrapreneur, if some people would say. What does the day in the life of a risk advisor look like? What are you doing on a day-to-day basis?
So on a day-to-day basis, my time is usually split in a few different categories, right? So there's the time that goes into just the day-to-day servicing of your existing clients, right? That's helping guide through the process of whether it's an acquisition that's coming up, a disposition, a refinance. There's always moving parts, particularly within real estate, right? And so there's a lot of day-to-day servicing. I mean, the interactions with a real estate client versus, let's say, a manufacturer is completely different, right? Just because of all those moving parts. So part of the time is spent with that servicing with myself and my team. There's another element of it of I'm trying to connect with new people. So before we hit a pandemic that involved going to lots of events and networking, and all that came to a screeching halt in March. So now it's been a lot more time on the phone, working through marketing, trying to figure out different creative ways to connect with people to bring in new clients, right? And then once you open that opportunity and you're starting to work on a new client, there's a lot of time that goes into underwriting. So if an investor says, hey, we want you to look at our portfolio, there's a lot of detail that you work through with them to gather the right information. And then you're compiling that information and really painting a picture for your underwriter. So, I mean, people have asked me before, what's the difference between a good broker and a bad broker, or good advisor, bad advisor? It's really making sure that you're painting a picture for an underwriter to make that client look really good versus here's 12 locations, here's all the basic raw data, what's my rate? If you actually go into more detail and explain, like, here's what the company does, here's what their practices look like, here's what they require of tenants, of vendors coming in and out of the space to do work, you can actually derive a much better result than just providing a spreadsheet and asking for someone to get you a quote.
Interesting. So almost painting a picture of the whole business, not just that one property you're looking for a quote on.
Exactly.
That's interesting. How about on the other side? So that's your prospect side, if you will, but how about the actual carriers that you match up with? How do you find these guys? How do you know if a deal is going to be right for a certain carrier? Because I know there's hundreds of insurance companies around. I used to live in Des Moines, Iowa, and I saw every one of the big...
They're all headquartered there.
Yeah.
Well, maybe not all of them, but a lot. So yeah, every insurance company has a different appetite, right? So there is some time spent with those carriers and with those underwriters figuring out what that appetite looks like. So every carrier will say they like real estate in some capacity, right? But the question is, what kind of real estate do you like? So back in the days when carriers would stop by the office and, have a catch-up meeting with us, they would talk about their appetite, what they've been hitting on recently, where they've seen success. And so the first question is always, what kind of real estate are you writing? So in some cases, it's they really like office and industrial. Some carriers really like apartments. Few carriers like every asset class. There are a few. And then I would say in today's market, it's even changing beyond what it has been historically, just because of the unknowns of, what will come of the pandemic, and particularly around office and retail and what that's going to look like. So we've even seen carriers backing away from those asset classes where they historically have been of the most appetite.
Yeah, that makes a lot of sense. So for example, how many carriers do you work with, if you had to guess?
So in the real estate space, I would say we probably have 15 or 20 that really focus in on real estate, that specialize in that. So the team that I came over with to help launch our Chicago office has really put a lot of emphasis into partnering with the right companies that work with real estate, because real estate is our focus. And so if there's a market we've come across that we find is really competitive in the real estate space, we do what we can to get a contract with them. So there's very few markets that specialize in real estate that we don't work with.
Yeah, and it's funny, we've worked with each other in the past, and you really know which carriers have an appetite for what type of assets. We do some niche style assets, not only the single family, the multifamily, but also the self-storage buildings. Mm-hmm. And you've gotten quotes to me, not only quickly, but usually beating out almost all of the competition on the premium. And I think one of the things that really helped was the fact that you do have a really good ability to paint kind of that picture. Here's what the company's like. Now, I'm somebody that always believes that you should get insurance and just, plan for the worst, but hope for the best. I have come across a lot of investors that do the opposite and swear that real estate insurance is a scam, and the carriers never pay out. So for you, what would you say, why should a real estate investor have property insurance? And on top of that, why should they use a risk advisor or a broker as opposed to just contacting a company directly?
Good question. So I would say, why should they have property insurance? The short and simple answer is, in most cases, if there's a bank involved, it's going to be required. Right. Where it's an option is where you actually own the asset 100%. There's no lender requirements. You can choose whether you're going to insure the building or not. I've seen this particularly be the case when you've got developers who are buying, let's say, a vacant property that they're going to repurpose, right? Mm-hmm. So usually in a lot of cases, they'll buy it for cash, or there won't be a bank involved, if you will. So they have a choice whether they want to cover that building or not. I would say the reason you want to is because you want to have something that protects your investment, right? And it's not just the asset itself, especially when you're looking at development projects. You might purchase a building for, let's say, $1 million. You're going to put a couple million into it, repurpose it. It's not just covering that initial $1 million investment. It's also looking at what is the potential income that you stand to lose if you lose that asset, right? Mm-hmm. Right. So insurance is, if you think about it, there's not a product out there where you can spend, let's say, I'm thinking back to one that I did for a client a while back. Bought a vacant building for it was like $500,000. Once he was done with the repurposing of it, he would have been into it for probably about 2.5, and the monetary return on this was going to be over $500,000 a year. Wow. Once it was all done. The coverage of insurance was like $8,000, but we were covering the building for $2 million, right? Yeah. So you're spending $8. In the event of a total loss, you're getting all of your investment back minus your deductible for $8K to protect an investment of significantly more. So, being someone that's fairly risk averse, I would strongly recommend it.
Yeah. And so you're talking about the significant income that property would bring in, is there some type of a rider that you can get for, say, instead of it being a total loss, but say something happens where all of a sudden you lose your income generating potential from that building? Is there some type of like loss of rents protection or income protection that you can put on as a rider?
So typically you'll have a loss of income or what's called business interruption coverage that's built in. So once you have a stabilized asset, it's generating rental income, you can cover that two ways. You can do it on a stated amount. So you're stating for every location that you have, this is what our annual income is. And if there's a claim, so let's say there was a fire at the building, right? The tenants have to relocate because you're doing all these repairs. It's going to take 6 months to do the repairs.
Yeah.
The policy will pay out that lost rental income for those 6 months until you're back up and operational again. That's based on a stated amount. It functions the same way. A lot of companies prefer to do what's called actual losses sustained, which means you report what the rental income is, but you're not capped at that number. This is particularly important on portfolios where tenants change, right? You don't want to have to go back and report every single time. Well, this tenant moved out, this tenant moved in, the rents went up a little bit, and change that number all the time. So having actual losses sustained, what they will do if there's a claim, they'll look at the time of the claim, what was the rental income, and that's what they start paying until the repairs are done.
And I know we're skipping ahead here, but what are your recommendations on the two methods, stated income versus actual? What do you prefer, or what do you advise people to go with?
I always prefer actual losses sustained if you can get it, just because it makes it very clean. So, a lot of times when you'll have an investor that's buying a new asset, they're typically inheriting tenants, right? They might be doing things to the building, providing more value, updates, all kinds of things, right? And with that comes typically at lease renewal time, adjustments in the lease. And if you have actual losses sustained, it doesn't matter what those adjustments are. You could have a unit that's going for $2,000 a month. You put a lot of value into it, updates, improvements. You're going to increase that from, $2,000 a month to $2,500 a month, or whatever the case might be. You don't have to go back and report it every single time. So you don't want to have a cap on what could be paid out for lost income. Actual losses sustained is a much cleaner way to do it.
Gotcha. So what are some of the decisions that an investor or someone would be faced with when choosing insurance? What should they be looking out for? What are the things that you're recommending they look for, or pushing them or nudging them towards getting, if it's additional riders, if it's certain types of policies? Kind of walk us through that.
So there's a few things that I always look for the first time I see a policy. So one of those things is coinsurance, which is a very confusing thing for most investors. Coinsurance has to do with how much you're going to cover your building for. So the average investor will always cover their building for replacement cost. Typically, that's the most standard way to do it. So let's say you have a building that's valued at $1 million at replacement cost. Coinsurance allows you to insure it for a little bit less than that. So typically you'll see either 80% or 90%. But if you go below that, there's what's called a coinsurance penalty, which means, let's say the building's $1 million in value. You have an 80% coinsurance clause in your policy. That means that you can be fully insured up to 80% of the value. So in this case, it would be $800,000, right? If you are insured for less than that, and there's a claim, even if it's a partial claim, they will subtract a percentage off of what would have been your claim paid amount based on how far under that 80% you are. So let's say you're insured only to 60% value. Well, you're 20% below where you should have been. Any claim that gets paid out is going to be docked 20%.
I see.
So what we do is we look at trying to put everything on what's called agreed amount, which waives coinsurance, which basically is stating, we've gone through the process to make sure we're insured adequately, right? But we don't want any risk of coinsurance or penalties if there's, a valuation difference between the time we wrote the policy and the time a claim happens. So the carrier is agreeing in their contract, they will pay out up to X, no questions asked, if that is on agreed amount. So that's one of the big ones we look at. One of the overlooked coverages, I think, is sewer and drain backup. And it's oftentimes put at a very low limit. But if you've gone through claims before, water damage in your lower level, that can cause significant damage to repair.
$60,000 to $80,000 worth of damage.
Exactly. So that's something that I always want to make sure is at a very good limit that's included. In the Chicago market, the other one is ordinance and law coverage.
Yeah.
So it's not automatically included, but it provides coverage for, let's say you have a catastrophic loss and you're dealing with a building that was built in 1912, right? It's been updated, but there's a lot of things that are grandfathered in just because of the age of the building. When you reconstruct, you have to reconstruct according to 2020 building code.
Right.
And that's an additional expense that is not automatically covered. So making sure that you have those kinds of things. So I really focus on trying to get into the weeds on this kind of thing to make sure you know exactly what it is you're purchasing and that it's actually protecting your asset, right? Because there's nothing worse than you go out and you purchase a policy from your broker, you have a claim, and then in that process, something's not covered. And you're like, well, I paid for this policy. Why is this not covered? It's like, well, this wasn't included, or this was sublimited, so only a certain amount of it gets paid, and you're left spending money out of pocket. The last thing you want is to spend money out of pocket after you've had a claim, and you're already dealing with that headache.
Right. How would you advise someone choose the right coverage for their building? It seems like property insurance is kind of like this: pull a lever here, lose a little bit on the other side, pull a lever on the other side, lose a little bit here. Usually it's with premium or with coverage amount. You're talking about things that are, let's call them named coverages versus unnamed,
right?
Issues. So what would you advise for someone and how they should approach choosing the right coverage?
So typically the way I've always approached it is I want to lay every option out there that's on the table, right? These are the coverages that are available. Here's the tiers at which you can get these coverages, right? So think about sewer and drain backup, for example. I can show you if you want 25,000 of coverage, it's going to cost this. If you want 50, it's going to cost this. If you want 250, it's going to cost that, right? And then based on the size of the building, what's your lower level construction type, right? Is it all block and stone? Okay, you probably don't need as much, as then you're looking at, fixtures and things like that versus, we have a frame, drywall, carpeted, lower level, right?
Yeah.
That's going to sustain a lot more damage. So there's a lot of consulting around based on what you have. This is what's recommended, but here are all the options. And so you lay that on the table, make a recommendation, but at the end of the day, it's up to that investor to choose what they want to proceed with.
What is the most common mistake or mistakes you see real estate investors make when it comes to property insurance?
I would say the most common mistake I see is that the first thing they do is they look at what the premium is and they make the decision based on the premium without actually diving into all of those little ancillary coverages, right? So they'll look at what the premium is and how much is the building covered for. They won't look at things like coinsurance. They won't look at is there any limitation on what my business interruption coverage is? Is equipment breakdown included? All of those little things that if there's a claim will have a big impact.
Yeah.
They're just looking at my building's covered for $1 million and it costs this much. That's the least expensive one. Let's go with that. Or also looking at what carrier are you partnering with? How does that carrier respond if there's a claim? Are they a carrier that really will push back and try to find any possible way not to pay a claim? Or do they have a good track record of really working with their insureds, right?
How do you find that information?
So that's where I think working with a advisor comes into play, especially one that's ingrained in the industry. by the industry, I mean the real estate industry. So someone who's worked with multiple carriers has been able to see claims walked out from multiple carriers and be able to say, I've seen experience with this carrier, this carrier, this carrier. They're all willing to offer you terms. Here's the pros and cons of each one and what I think their strong suits are.
Gotcha. How about on the flip side? What are some of the common mistakes you've seen risk advisors make?
I would say the two that I see the most would be not going into full detail and doing the full underwriting themselves on the front end. So like I said before, there's a lot of brokers out there. I mean, there's thousands of insurance brokers, right? I mean, you can go at anybody you want to get insurance pretty much.
Right.
But if they are not going into that full detail and figuring out all of the things on the front end before they start quoting something with a carrier, there's a lot of things that can get missed, right? Not actually doing the legwork to make sure, are we covering the building adequately? Are we running the right reports to make sure that this asset will be fully protected up to the investment level that the investor has, right? Are we including the right coverages? Are we asking for the right endorsements or add-ons, right? I would say that's probably the biggest mistake, because that's where you find they rush through the process, they get a quote, something happens, and then there's an item that wasn't covered, and then it's up to that broker to make that right. So I would say that's probably the biggest mistake I've seen. The other is just not actually, like I was talking about before, painting that picture with an underwriter. The difference that you can get for a client through that is huge. It's really, that's a way to create value for an investor when you do it that way, versus just spitballing out there to any carrier you can to get a quote. And it's also a way to potentially lose the client in the long run, because you're going to get the best pricing when you paint that picture, versus you're just marketing it out to everybody and taking a shotgun approach. It's very easy for somebody that really knows what they're doing to come in and create that value, drive down that cost, and then you lose the client. So
one of the things that I have seen is trying to do everything yourself, as opposed to building out a team to help you with that. And you've alluded to it multiple times that you have a team around you that helps you fill these duties. What does that look like? What does your team look like, and what are they responsible for each?
So on the team is built out of, there's multiple advisors in my firm, multiple ones of us that focus in real estate. I think one of the real advantages is the way we've built out this office is we have professionals that are focused not only within real estate, but within various aspects of real estate. So you have guys that are really focused in the multifamily space. You have guys that are focused in commercial, meaning like office, retail, industrial. You have others that are focused in condominium associations, right? So it creates a wealth of knowledge that you can pull from. So let's say you're working on something that's a little bit outside of your wheelhouse. You have that resource that you can bring in to make sure that nothing's getting missed through that process, right? There's expertise there. There's also a service team that handles a lot of the transactional pieces that happen within a real estate account. So when you're going through a refinance, there's documentation that the lender needs to see based on what you have on your insurance policy, evidence of coverage, et cetera. We have a team that, one, processes those changes, provides those certificates when they're needed, helps process the day-to-day things of those transactions that you're doing on the front end, behind the scenes with the carrier, so that people like myself, the advisors, can really interact more with their clients and do the consulting piece.
Yeah, that makes a lot of sense. So let's move back to, say, new investor, new real estate investors looking to get involved, just saw this podcast. What advice would you give them when they're looking to buy their first investment property or start their first project? Let's say maybe it's, instead of a rental, it's a fix and flip property.
Right. I would say, as someone new that's getting into it, I think the most important thing you have to think about when it comes to insurance is partnering with the right broker, because a lot of people are generalists that'll say, sure, I write real estate. I also write restaurants, and I write manufacturing, and I'll write a trucking company. And they're not ingrained into the industry. And there are brokers that really specialize within an industry. Like myself, that's real estate, right? As a new investor, there's a lot of education that comes with that first investment, that first project, even the first few, right? And so being able to partner with someone that is part of the team with you, that can say, okay, based on what you're investing in or the project that you're doing, these are all the things you want to consider, right? You don't have to go with all of them, but at least you have the information and you can make an educated decision.
And then how about on the flip side? What advice would you give to somebody considering becoming a risk advisor or an insurance broker?
I would say if you're going to become an insurance broker or an advisor, the most important thing I think you need to be able to do is specialize in an industry for the same purpose, right? There's obviously a lot of change happening within the insurance industry, right? I mean, online rating systems are on the rise. I mean, think about your home and auto insurance, right? You don't have to go through a broker to get home and auto insurance. You can go online, plug in your information, a quote will get spit right back out at you. It's turning it into very much of a commodity, right? I think in the commercial space, there's still a lot of room to bring value to clients, right? But the only way you bring value is if you can bring consulting and advice. And you can't bring consulting and advice on 12 different industries. You have to really be able to understand how your client's business works and speak to that versus taking orders or reacting to what they're asking for when maybe what they're asking for isn't actually going to protect them the right way. You want to be able to bring value, and that's the only way you can do it.
I always tell people, especially new investors, for real estate investors, it's good to be a jack of all trades and master of none. But then you surround yourself with with advisors that are the opposite. Each one of your advisors is a master of one thing, not a jack of all trades.
Right.
So, I've worked with you in the past. I know a lot of people that worked with you in the past. What can a real estate investor do to make themselves a good partner, a good client to you, so that the interaction between the two is seamless and you don't want to scream every time you see Fernando calling you on the phone?
Yeah, I would say communication is probably the biggest thing, right? I was talking with a colleague about this a couple of years ago, and I was like, you can tell a difference between a client that views you as a vendor and a commodity versus a client that views you as an advisor and part of their team, right? And the difference there is they're bringing you into conversations about what the future looks like in advance. So I've got some clients that are really good at this, where we have quarterly meetings and we'll talk about, this is what's in the pipeline. What do we need to be thinking about? Let's prepare for this in advance. They'll ask a lot of questions. And you particularly see this where if you've got an investor who's maybe changing the direction of their focus, right? So let's say I've talked to some groups recently where historically they've done a lot of work in the office and retail space. They want to launch a multifamily division. And so they'll say, okay, we're changing direction here. What do we need to be thinking about as we start looking at a different kind of investment versus what we've done in the past? With those kind of conversations, the process is much smoother versus I have a portfolio of office and retail, and oh, by the way, I forgot to tell you, I'm closing at noon tomorrow on a 80 unit apartment building. I need you to get this added for me. Which, if there was no conversation on the front end, who knows if the carrier that you're with, you could even add that location to, or you have to go and get something from scratch, and you're on a deadline to do it. So I would say the communication and just having open dialogue about what's going on within the company and asking questions and keeping that line of communication open is the best thing a client can do.
Yeah. I mean, that makes a lot of sense. It's with almost any advisor you work with, you got to really make sure you're communicating not only often, but well in advance of when you need things to be done by a certain deadline.
Right.
So with that being said, how can people reach you, and what should they know, or what should they prepare before trying to contact you or reaching out to you?
So I can be reached. My contact info, I believe, is on our website at www.crum-halsted.com. I also can be reached by phone, email. I don't know if you'll have that information up later, but that's typically the easiest way to get a hold of me, phone and email. As far as what to have prepared, I mean, typically I like to start just by having a conversation with what is it you're looking for? What do you have? What's the plan? One of the things that I've tried to do that's a little bit different with clients is not just looking at what your particular need is right now, but also like, what's the next 12 months look like, right? So I was, a good example of this, I was talking with an investment group that so far all of their investments have been in Chicago, right? But over the next 12 months, they're trying to start investing in multiple states. And so having an overview conversation around what the plan is really helpful, because you want to set a platform that a client can grow from, right? So as far as what they have prepared, just have a conversation, and then we can kind of direct from there what information we need.
Yeah, that makes sense. Come prepared. Yeah, I know you like to get involved a little bit earlier in the process than what most investors will involve you in the process, right?
Correct.
How many, let's say I got a closing on December 30th. When should I call you?
I mean, I would say as far in advance as possible.
Okay. Right when we go under contract then?
Yeah, right as you go under contract. So it really has to do with, it's not so much what our timeline is. Really, it comes down to what the carrier's timeline is, right? Because when we get that phone call that says, hey, I'm closing in 4 or 5 days, there are some carriers that could be really competitive in that space, but they can't turn it around that quickly. Because they already have so many files on their desk that they're trying to work through, they're not going to jump on the last minute one that just came in and push everything else they've been working on to the side, typically. So as much in advance as you can is great. That being said, there's always options. I mean, I've done it before where I get notification 2 days before we put something together. It doesn't allow us time to go out to all of the options, right? But it still allows you to provide some, right? Yeah. And then you talk at that point of, okay, so what's the strategy after we move forward with this? Do we try to remarket it down the road at next renewal, start the process earlier, et cetera?
That makes sense. Well, hey, Greg, I really appreciate you coming on. Thank you for giving us the scoop in on property insurance and risk advisors. Everyone that is watching, they'll have a link to your contact information below, as well as the website there, with whatever you'd like to provide.
Awesome.
And thanks again, everybody, for tuning in to What's the Deal, the real estate podcast that gives you answers. If you have any questions, or if you have certain topics you'd like us to cover, feel free to comment below, and we'll get back to you as soon as possible. And that is our Thanksgiving edition of What's the Deal. Hope everybody has a very safe and happy holiday.